Imagine a casino where the house doesn't just win because of the odds, they win because they can change the rules of the game while you're playing it. They manage more money than the GDP of entire countries. They can crash economies before breakfast, force Fortune 500 CEOs to fire themselves, and take home billion-dollar paychecks even when the rest of the world is burning. We aren't talking about your retirement account. We're talking about the apex predators of finance, hedge funds. From the math wizards who solve the market like a code, to the culture of brutal honesty that borders on a cult. Today we are breaking open the black box. What exactly are hedge funds? How do they make money when the market crashes? And what does it take to actually get a job at one? Let's dive in. To understand a hedge fund, you first have to understand what it isn't. Most people invest in mutual funds or ETFs. Think of a mutual fund like a Honda Civic. It's safe, reliable, and it gets you where you're going by following the traffic laws. If the market goes up, you make money. If the market crashes, you lose money. A hedge fund is a Formula One car. It's dangerous, complex, and it's designed to go fast regardless of the weather. Their goal is absolute return. That means making money whether the market is booming or completely collapsing. But here's the catch. You're probably not allowed in. Hedge funds operate behind a velvet rope. To invest, you need to be an accredited investor. Basically, you need a net worth of over $1 million or an income of $200,000 a year. Why? Because the government views these funds as lightly regulated. They are the cowboys of the financial Wild West. They don't have to tell you what they're buying, they don't have to follow the same safety rules, and they charge a fortune for the privilege. It's called the 2 and 20. They take a 2% fee just for holding your money and 20% of every dollar of profit they make. If a fund manages $10 billion, they wake up on January 1st with $200 million in fees before they've even placed a single trade. So, how do they justify those insane fees? They use tools that would terrify a normal investor. First, short selling. Let's say you think a luxury watch currently worth $10,000 is going to drop in value. You borrow the watch from a friend, sell it immediately, and pocket the $10,000 cash. A week later, the price crashes to $8,000. You buy the watch back, give it to your friend, and keep the $2,000 difference. That is shorting. You are betting on failure. Second, leverage. This is financial steroids. If you have $1 million, a bank might lend you another $5 million to trade with. If you win, your profits are massive. If you lose, you don't just go to zero, you go negative. As Warren Buffett says, leverage is the only way a smart person can go broke. Hedge funds don't just guess. They use specific strategies. Here are the big three. Number 1, the long-short equity. This is the classic move. You buy the best horse and shoot the injured one. Let's say you think tech is the future, but you hate company X. You buy Apple, and you short company X. You're trying to hedge your risk so that even if the whole tech sector drops, your short position covers your losses. Number 2, the global macro. These are the guys playing risk with real countries. They bet on wars, elections, and interest rates. The most famous example? George Soros. In 1992, he realized the British pound was artificially overpriced. He bet billions against the Bank of England. He broke the currency, forced a devaluation, and walked away with $1 billion in profit in a single day. Number 3, the quants. Forget gut instinct. These funds use physicists and mathematicians to write code that trades millions of times a day. The king here is Jim Simons of Renaissance Technologies. He was a code breaker for the NSA. His medallion fund has average returns of 66% a year. To put that in perspective, he makes Warren Buffett look like an amateur. But it's not just about the math, it's about the personalities. You've got Ray Dalio of Bridgewater. He runs the world's largest hedge fund based on radical transparency. Imagine a workplace where every meeting is recorded, and interns are encouraged to tell the CEO he's speaking nonsense. It's intense, but it works. Then there's Bill Ackman. He's an activist investor. He doesn't just buy stock. He buys enough to force his way onto the board and demand changes. He once went to war with herbal supplement company Herbalife, calling it a pyramid scheme and betting $1 billion it would go to zero. Spoiler alert, he got into a massive public feud with another billionaire, Carl Icahn, and actually lost money on that one. And we can't forget the dark side. In the 90 seconds, a fund called Long-Term Capital Management had Nobel Prize winners on staff. They thought their math was perfect. They used insane leverage, borrowing $30 for every $1 they had. When Russia unexpectedly defaulted on its debt, the math broke. The fund imploded so hard the Federal Reserve had to step in to prevent a global financial collapse. So, you want to drive the Formula One car? You want the $1 million bonus? Here is the bad news. It is the hardest club in the world to join. The path usually looks like this: Ivy League degree to 80-hour work weeks at Goldman Sachs or Morgan Stanley to hedge fund analyst. There are two ways in. The fundamental path. You are a detective, you read balance sheets, talk to suppliers, and find things the market missed. Or the quant path. You are a genius. You have a PhD in physics or math, and you can code algorithms that predict the future. If you get an interview, don't expect them to ask about your greatest weakness. They will test your risk assessment. They might ask, I have a coin that lands on heads 51% of the time. How much of your net worth do you bet on it? Or they'll ask for a stock pitch. Tell me something to buy right now, and tell me exactly when you would sell it if you're wrong. They don't care if you're passionate, they care if you can be right when everyone else is wrong. Hedge funds are the villains of the story to some, and the heroes of capitalism to others. They provide liquidity and expose fraud, but they also amplify risk and profit from disaster. But one thing is for sure, they are the most powerful force in the financial universe. If you enjoyed this deep dive, let me know in the comments. Do you think hedge funds should be more regulated, or are they just playing the game better than everyone else? If you want to know more about the investment banking bootcamp you have to survive to get here, check out this video right here. Thanks for watching, and I'll see you in the next one.